Okay, everybody. I'm going to go ahead and get started here. It is 6 o'clock. Thank you guys for joining me. This is kind of our first quarter economic update kind of kickoff, kind of talk about some things that we see for the year 2021. Talk about a little bit of housekeeping items for us, and some things that we should be doing in 2021 here. So let's go ahead and get started here. If you have questions, please feel free to type them in as we go. I'll try and answer them as I go along. And let's get started here. Just going to jump through all this fun stuff here. So, we have pretty bright days on the horizon. We have all the news of the vaccines coming out and the rollout coming out. We still have pretty high spread, increased hospitalizations, and unfortunately the deaths of COVID are pretty close behind there. We have a lot of enthusiasm because of the vaccines by Pfizer and Moderna, AstraZeneca, and the Oxford group, really giving us some sooner than expected enthusiasm. But there's still a lot of issues that we're experiencing, particularly here in the U.S. Maryland in and of itself has been having its issues with the vaccine rollout. So that is a risk to kind of everything that's been going on out there in the market. We still have COVID. It is still a risk. Yes, the vaccine is out there, but there's still a very large risk to the U.S. economy. I don't think that we will have massive shutdowns like we saw in the past. I think there would probably be a lot more localized shutdowns, kind of similar to what we're seeing in Maryland, where each of the counties is having its own individual shutdowns. We have England went into full lockdown. So I think it's going to happen. I don't think it's going to be as prevalent as before. But be it as it may, there is that COVID risk. It's not, now that we're in 2021, it's not just magically behind us because we have vaccines. There's still a lot of ways to go, probably well into the summer before the vaccine rollout really reaches the general public, is kind of everything that we're seeing. So this was a slide that I showed for our fourth quarter, really showing that a lot of the growth out of the S&P 500 in 2020 came from the big five stocks, which is Apple, Microsoft, Amazon, Facebook, and Google. From February 19th, those five stocks were up about 33% from February to October, November of last year. While all the other 500 stocks on the all of the 495 stocks on the S&P 500 were down 1% as of that same time. So a lot of the movement in the S&P 500 in 2020 was all large cap stocks, those top 5 companies. You'll notice in the portfolios that we have made a shift from large cap into small cap and mid cap, which is those other 495 stocks on the S&P 500. The reason behind that is if we take those same 5 stocks, those big 5 stocks in the S&P 500, they reached their peak on September 2nd. As of September 2nd, those particular, right here, those particular 5 stocks were up about 65% for the year, and all other 495 stocks in the S&P 500 were only up 3% for that year. So we had 5 stocks up 65%, and 495 up 3%. Since September's peak, we have had a reversal where we are seeing those big five stocks that Microsoft, Apple, Amazon, Facebook, and Google have seen a 7% decline since September 2nd, and all other 495 stocks in the S&P 500 have seen that same exact 7% increase. So we're seeing this rotation out of large cap, large growth into much more small and mid cap value, small and mid cap growth. So that's where we're kind of moving, directing that portfolio, because that is where the momentum in the stock markets has actually shifted. You know, we talked about last quarter, Mike and I, adding that momentum factor to the overall portfolios to take advantage of these trends, because the technical and fundamental analysis that we followed for years and years and years wasn't showing, the data wasn't showing the right amount of information for us. And kind of to just illustrate that fact, one of the things that we look at is the leading economic index. It combines manufacturing, jobless claims, non-farm payrolls, a bunch of different factors of economic indicators, and combines them all together. And what it's showing us is right here, these are our pre-pandemic levels of right around 112 on this index. And then when COVID happened, we fell all the way down to about 97 on this index, and we've only rebounded a little bit. So we're still, the fundamental and technical analysis that we look at is saying that we're still at much, much lower than pre-pandemic levels. We haven't gotten better. The stock market should not have zoomed like it did. But when we go back, what the stock market's reacting to, what the momentum reacts to, what the speculation reacts to, is we're looking at these leading economic index month over month change. And that's where that V-shaped recovery thing that people talk about, that's what happened, is we had this very large drop off from our pre-pandemic level down to when the pandemic first really kind of got up and rolling. And then it rebounded so quickly because we went from a very low level to, you know, a positive number. I like to explain it in terms of manufacturing. The manufacturing indexes were right around 88% factory capacity pre-COVID. When COVID hit, we dropped to about 3%. Now we've gone from 3% to about 12%. Well, right there, we have a 400% increase in manufacturing capacity. Never mind the fact that we're now at a level of 12 and not at the previous level of 88. So things are getting better. The growth is happening. The momentum is really what's been leading the way as far as the U.S. economy goes. You know, really what we're seeing is some industries are still needing some type of assistance. We are in more of a K-shaped recovery where the things that did really, really well was technology, retail, software services. Retail pretty much being led by Amazon because everybody was buying things off Amazon. Technology, people were using Zoom and GoToMeeting and FaceTime and all the other video chat platforms. And software services, there was a much greater need for those types of things in the pandemic. The travel industry still suffering greatly. We have cruise lines that they're not cruising, airline industries, they're not traveling. The entertainment industry, you know, that's anything from concerts, sporting events, movie theaters, anything like that still has not come back. Yes, it has opened up some, but it hasn't opened up a whole lot. The hospitality industry, that's our hotels, food services, that's our restaurants. All of those industries are still struggling. So we need this recovery, this momentum to keep going. And there are a couple headwinds to this economic recovery. Kind of feeding into that momentum style that we've now implemented in the portfolios. This is the call option volume across all the U.S. stock market. For those of you not familiar, a call option is where the buyer of a call gets the option to buy a specific stock at a specific price. The buyer typically thinks makes their profits as that stock increases. So people are thinking that stocks are going to continue to go up because they want to try and buy them at lower prices when they actually increase in value. So when we have this level of call volume, when it gets to a high, really what it's saying is that there's a lot of speculation going on in the market. It doesn't exactly mean that we're going to have this massive pullback. It doesn't mean we're going to have a sudden reversal, but it does mean that the stock market can be very subject to any type of negative catalyst. Raising taxes. That's been one of the things that Biden has said is, I'm going to raise taxes. How it looks like, what it looks like, that really is one of the things that could kind of grind this recovery to a halt. Anything that is related to the virus that's negative, anything with the vaccine that's negative, can really bring this to a halt as well. The fourth quarter, really the focus was on international and emerging markets, developed markets, international, emerging markets. That's really what did well in the fourth quarter. And what we're seeing here is, you saw in the portfolios a little bit of a rotation into international emerging markets right around October, where we saw a little bit of divergence. And then we really saw a much larger divergence in the performance of the emerging markets and international markets versus the S&P 500, and moves were made in the portfolios right around mid-November to kind of take advantage of that. Optimism over the vaccines really helped drive the market. We think that this is probably where a lot of the growth for 2021 is going to come from. It's going to come from the emerging market space and the international space. China led a lot of the recovery in the global markets in 2020, but all the emerging market performance wasn't really based in China. China's now facing its own problem where they have a lot of lockdowns. They really didn't respond that much to news of the vaccine, and it's probably because, in Asia, there wasn't a lot for them to gain in the vaccine coming out. Yes, it helps them, but the virus is much more under control in that region. China's economy was already growing pretty rapidly after kind of almost fully recovering from the pandemic, and that's really just due to the fact that the Chinese tend to wear masks, and they listen to what the government's trying to do, because that's what they have to do because of the type of government that they run over there. Emerging market stocks, a lot of the strong performance came out of Asia, but a good bit of it came from Latin America, Eastern Europe, Africa, and the Middle East. Particularly in Latin America, a lot of the growth came out of Brazil. Equities have really performed well in Brazil, despite the fact that Brazil is having a pretty strong outbreak of COVID again. So really, we think that there's going to be a lot, because of the vaccine coming out, because of the light at the end of the tunnel being seen at this point. A global recovery in travel and transportation is probably going to happen in 2021. There's going to be a shift in the U.S., at least, for energy stocks, material stocks, and I think that's going to continue across the globe, really helping out those commodity-driven economies in Latin America, Eastern Europe, and the Middle East. So I think that this is going to be one of the areas. A lot of the Wall Street analysts are saying that these are going to be the good areas. There's a lot lower valuations in the emerging market and international space, as far as when we're thinking about price to earnings ratios. That's one of those big things that people ask about, the price to earnings ratios. Well, the price to earnings ratio in the United States is a lot higher than it happens to be in the international space, in the emerging market space. There's a lot more value to be had there. This is really just the estimated earnings growth for the S&P 500, what they estimate it to be. So you can see third quarter, fourth quarter of 2020 was supposed to be bad earnings, and then they think we're going to have huge earnings gains in the second quarter of 2021, and then just kind of continue on out there. That's really just because companies are benefiting from that pent-up demand. Now that things have opened back up, things are opening back up a little more, the vaccine's in sight, really much more optimism out there. So these are those PE ratios that I talked about. Really we see the value. Here's our price earnings ratio for the United States, just above 20%. Meanwhile, in the emerging markets and the international markets, we're somewhere around 16 to 15%. So much lower price earnings ratio. So we'll be able to take advantage of that growth that happens in all those stocks on those indexes. Just a different look. This came from that third-party analyst that we've hired. What it's showing us here is that same type of thing. This is really just how the PE ratios have moved over the years. We see this massive, massive jump up in the United States of their PE ratio right around 22% versus 17% and 14% in the international market. So a lot more value to have in the international emerging market space, which is why you're seeing those positions start to tick up in higher allocations inside of the portfolios. In early December, we had bond yields rise to the highest level since the crisis, and it's really just fueled by optimism about our future economic growth. Markets are overlooking the near-term damage to the economy, and they're thinking about stronger growth in the second half of 2021. So our 10-year Treasury is now approaching 1% for the first time since March, and our yield curve is still pretty steep. There's a pretty big difference between long-term and short-term. So, Mike and I always have been talking about, we've implemented this strategy with a lot of our clients where we took the risk off the table with our fixed income side of things. Because if interest rates continue to stay at zero and you're in fixed income, you're in those bonds, you're not really seeing those types of returns. The only place for interest rates to go is up. Certainly they can't really go down much lower because the Fed's target is right at 1%. When interest rates go up, the prices of bonds fall. So that safety net that people think that is in bonds is not going to be there. Now they've said they want to keep Treasury rates low for the next 3 years. So that's through 2023, they want to keep rates low. Well, in the meantime, if those rates are earning nothing, we might as well take advantage of it by using those fixed index annuities with North American and Delaware Life and Equitrust. We can use those products to take advantage of the short-term upside in the market while reducing the downside. And then once we get past the interest rate rising period of right around 3 years, we take the money out of those things and we go right back into bonds. That is the overall strategy. That remains the overall strategy that we started implementing 2 years ago. We're continually doing that with our clients. We're doing that with all clients going forward. Here's our yield curve. You can see that the difference continues to rise. So we continually have our long-term bonds paying less than our short-term bonds. Really they have become a little bit more optimistic in hoping for yet another round of stimulus. Corporate bonds, we're seeing a nice little jump. Corporate bonds have certainly outperformed Treasury bonds, which means that investors are willing to take on more risk at this point. They're not as worried about those corporations issuing those high yield bonds, not as worried about their ability to repay that debt and principal. So this is the Fed funds rate. Right now, we're basically at zero. We are at zero for the Fed funds rate. This is the rate at which they loan money out to banks. You can see we're going to stay at zero for the rest of 2021, the rest of 2022, and 2023. And they want to get that number back, but they don't want to start raising the Fed funds rate, because then it raises interest rates. It makes money more difficult to borrow, more expensive to borrow. They want people to borrow money. They want people to go out there and spend money. That is what's going to keep this economy going. People need to be spending money, which is why one of the greatest risks to the economy right now is raising taxes. Because if you say you're going to raise taxes, people are thinking that they're not going to have as much money in the future, so they're not going to spend as much money. So that is one of the bigger risks out there. So, for 2021, Democrats now control the policy agenda, but they have challenges. They have narrow majorities in both the House and Senate, which means that the incoming administration is going to have more freedom to pursue the policy priorities that they have. It's going to be difficult, but not as difficult as if it was facing a split Congress. So really that's the risk out there. We're going to have a much more democratic viewpoint as far as policy goes. There was talk prior to the election, right after the election, to expect another economic stimulus package. Really, there was bipartisan support on both sides of the aisles to make $2,000. So if we do another stimulus package, that could be part of it. The priorities for the Democratic Party really happens to be, in making aid to state and local governments, making more funding for vaccine distribution. They want to extend out those unemployment benefits. Currently, the extended unemployment benefits are due to expire on March 14th. They want to extend the eviction moratorium, student loan relief. They want to spend more money on infrastructure. That is something that both parties really support, is spending more money on infrastructure. So to us, that means materials is going to be a big play for 2021, the materials sector, the energy sector, because there's really a big push in the Democratic Party for green energy. So those are the areas that you'll see the portfolios move into for 2021. There's going to be a lot more debt added on to the federal budget. They want to spend more money. They need to figure out how they're going to pay for it. But it's definitely going to be rebuilding the infrastructure, improving the infrastructure, improving the energy grid to make things much more efficient is going to be a top priority for the new administration. You want to remember that tax increases are on the table. Biden is the first president in I don't know how many years, for as long as I can remember, who ran on a platform of, I am going to raise taxes. The increases on the table, probably they're going to be used to help offset the new administration spending plan. How are we going to pay for improving the infrastructure? How are we going to pay for improving the energy grid? We're going to have to raise taxes. There's ideas for them to do increasing the corporate tax rate, returning the top individual tax rate to 39.6%. There's other things out there where they're talking about increasing the estate taxes, increasing taxes on capital gains, increasing taxes on dividend income for wealthier filers. Those are things that they are going to be tougher to get through Congress. Regardless of if it's a Democratic Congress or a Republican Congress, those types of tax increases are going to be hard to get through. Realistically, if we think about when Congress is in session once the Biden administration is in there and everybody else is put in place, realistically, the soonest they could get a tax package passed is probably by mid to late April of 2021. That's all they concentrate, and there's no big fights about it, and this is kind of what they get done. So any tax increases in 2021 are likely to take effect before 2022. There is a very, very little historical precedent. It's very, very hard if they were to pass a tax increase in April of this year and say, oh, hey, by the way, this tax increase was effective in January of this year. So it's very, very hard for them to backdate it. So more likely than not, we will have time to interpret the new tax law and plan for these changes in the tax code. We've been talking about Roth conversions for the past 2.5, 3 years, how important it is to do Roth conversion. If they change the tax code, they change the rates, they change the brackets, we will make adjustments to the plan so that we're not getting whacked with taxes unnecessarily. Some of the new legislation out there back in November, the House of Representatives proposed a new bill that is kind of like the Secure Act 2.0. It stands a pretty good chance of being voted on in 2021. If you guys remember the Secure Act, what it did was it said your heirs can no longer stretch out your IRA over their lifetime and take all the money out of your IRA when you pass away within a 10-year period. Typically, when we inherit money from our parents, we're between age 55 and 65, which are our highest earning years. If all of a sudden your kids are having to take money out of your IRA when they're making the most amount of money in their lifetime, and it's big amounts because that's to come out in 10 years, that is a lot of taxes. That's really the importance of doing those Roth conversions. It also took that RMD age from 70.5 to 72. In this new Secure Act 2.0, one of the biggest things that's in there is moving that RMD age from 72 to 75, which will allow you to defer your money in there, let it grow to a bigger account, because the larger dollar amount you have in there, the larger amount of tax dollars that the IRS gets to get out of them. The Secure Act, I think it stood for Setting Every Community Up for Retirement Enhancement Act. Mike and I like to joke that it just stands for securing a revenue stream for the IRS for the foreseeable future. So they're going to make changes to it because that is one way they can raise tax revenue without actually raising taxes, by making changes to retirement plans, making changes to estate tax rules. These low interest rates are probably not going to move. We want to have alternatives for those bonds. We want to have alternatives for your corporate bonds, your bonds funds. Let's look to some alternatives in 2021. Like I said, there's going to be some possible changes to the federal estate tax exemptions. Right now, it's $11.3 million you can pass. They're talking about changing that. So we're really just trying to attack the wealthy with that. The Secure Act 2.0, I really talked about that already. Changing the way your retirement can be taxed in the future is really what that is about. We want to make sure that no matter what happens in the markets, we have the income that you need. We're eliminating the market volatility for your income needs. Let's talk about Roth conversion. Tax loss harvesting is something you should always do. We're using those fixed index annuities to allow participation on the upside of the market without the downside. We've been using this in pretty much all of our clients' portfolios as a replacement for those bonds, because if bond yields are low, they're not paying anything. And then if they raise interest rates, the safe money you have in bonds, you can lose that, because as interest rates rise, the prices of bonds fall. So it can be a replacement. If you have not had those conversations with Mike or myself, please feel free to give us a call to talk about that. One thing that people really overlook is considering using life insurance for legacy planning and as a way to create tax-free income for you and tax-free income for your kids. We talk about it when we're talking about Roth conversions, but now with Congress talking about making changes to the estate tax law, life insurance should be a conversation, a tool that you might want to use in your financial plan. We're still open. We have some limited face-to-face appointments. Mike and I do a lot of Zoom meetings, virtual meetings with our clients, simply because you don't want to take the risk when it comes to your health, and we don't want to take the risk for you guys. So we have those virtual appointments available. You want to take a look at your estate documents. This is something you should look at every single year. You want to make sure that your estate plan documents are up to date. You want to make sure that everything is going to happen the way you want it to happen. Now, let's take a look at those Roth conversions. Let's make sure we're maximizing the amount of money we're getting into those Roth IRAs before tax rates go up. Because right now, I know at the end of 2025, the Trump tax rates expire and we go to the Bush era tax cuts. What happens between now and then is a complete question mark. And I apologize if you can hear that banging noise. That is my daughters upstairs cleaning up their playroom. Let's evaluate your risk factors. Let's make sure we have those income streams secure. Like I said, hold on here. Let me just pop this out here. We have that third-party portfolio analyst now on staff to give us that momentum, that emotional approach, that Twitter approach to the portfolio. The question's been asked, how do we take into account the extreme political volatility in DC into account, at least for the short term. Certainly we're taking that into account, and that's kind of having that emotional approach to the portfolios, the reaction that people have to that. The market, the stock market itself does not really seem to be reacting to everything that happened. Certainly with all the talk of there being the same type of protests at all the state capitals, things like that, that is a pretty big factor to what's going on. But that's why we have that momentum approach. That's why we have that emotional approach. So it's not as if we're not taking a look at that, the political volatility, because that is going to remain there. That is going to remain a factor in the U.S. For the next couple of years at least. I wanted to take a minute. I'm just going to skip through this. We talk about using those fixed index annuities to give you that upside of the market without the risk. You want to make sure you have those cash reserves. Typically, Mike and I say 3 to 6 months worth of expenses in cash reserves. That's really what you should have in cash. Now I want to take a minute. Mike and I have been really going back and forth with Adrian about taxes. And while Mike and I understand last year was very difficult. Not only was it difficult on the staff, it's difficult on you guys as our tax clients, because we did not get to have that same type of personal interaction, that same type of face-to-face interaction where you get to come in the office, sit down with Mike or I or Andrew or Ivan and have those conversations about your situation, not just about taxes, but kind of about life. We realized that people weren't able to have that last year. And there were some little bit of issues we had to work through as far as people getting us documents and processing everything accordingly. But, we want just to remind you that Mike and I are really focused on, the safety of our clients and the safety of the staff at this point. We're going to try and be as efficient as we can with taxes this year. We're not going to be doing face-to-face appointments this year. We'll probably have a handful of those for very specific situations, but preparation is going to remain virtual this year. And it's simply from the fact that Mike and I have about 1,200 tax clients that come see us every single year. If we have that amount of people coming in and out of the office over a 3-month period, it really ramps up the possible exposure and the safety, not only for the staff, but for you as our clients, because you guys don't want to be in an environment where there's been 30 other people in that office touching those pens, touching the countertops, touching the handles. All that type of exposure is possibly there. But everything will be virtual this year, but expect changes from 2020 because we want to make the experience better. We're trying to make the experience as seamless as we can. Part of what we're doing is we're going to be instituting Zoom meetings and phone calls to discuss the return beforehand. If you want to have that 10, 15, 20-minute conversation with Mike or myself or Andrew or Iva beforehand, and then once the return is completed, we are more than willing to set aside that time to go over the return with you, talk about any questions that you might have. And I think the most efficient way for us to do that is by using Zoom, where we can throw the return up on the screen and we can walk through it with you on the computer, safely social distance. Mike and I are still trying to, Mike, Adrian, and I are still trying to hash this out over this next week or so. We're having some discussions with our tax software about how we can work out electronic delivery of your tax documents, make it as seamless as possible so there's no frustrations. Trying to eliminate all the frustrations we had last year, simply because we went from being wide open, business as usual, one day, and the very next day, we had to close the office down. But we appreciate all of our clients. We appreciate you working with us and sticking through last year with us, with all the frustrations we had for tax season. We truly can't do the things we do without you guys, our clients, and the trust that you place in, the trust and faith that you place in Mike and myself and the rest of our team. But if you have any type of questions on anything that I talked about, please feel free to give me a call or give Mike a call. Give us a call at the office, shoot us an email, anything like that. But that's pretty much everything I have for the night. I hope everybody had a wonderful holiday, a wonderful new year. One last question here. Where's the greatest infrastructure opportunity, whether it's domestic or it's global? I think part of the greatest opportunity is probably going to be domestic at first, because that's where the new administration, I should just call it the new administration, is really focused on increasing our infrastructure. And then that will have that trickle down effect in the emerging markets and the internationals, because when we're using up those materials, that is where we're sourcing it from, the international market. So I think the greatest infrastructure opportunity is here in the US, and that's kind of where our infrastructure focus will be for the year. Let's see, another question. Does crypto rock? So cryptocurrency, I think that, and this is just going to be a very brief answer here. I think the cryptocurrency, if you want to have a small portion in your portfolio in cryptocurrency, I think there's nothing wrong with it. I do think it tends to be a little bit speculative. Simply, we saw a pretty huge run up and then it came back and now it's kind of bouncing all over the place. Just really depends on what cryptocurrency you want to use. Bitcoin, one Bitcoin costs somewhere between $30,000 and $40,000. I can't remember the amount. So what cryptocurrency do you want to use? Are you picking IBM, or are you picking Falcon? Are you picking AMC Motors, or are you picking General Motors? That's kind of the thing with how it goes with that. The same question when people were asking me about what vaccine company, what pharmaceutical company should I buy? It really just depends on, kind of what you think out there. So there are some ETFs that handle cryptocurrency. That's a great way to invest in cryptocurrency if you don't want to pay $30,000 or $40,000 for one Bitcoin. Just like you can buy ETFs that focus on vaccine and vaccine delivery and transportation of vaccines. You can buy those types of things. If there is an index out there, there's a position out there for us to go get and go purchase for you and kind of go from there. But that is everything, guys. Please feel free to give me a call. Shoot me an email, shoot Mike an email. Thank you for everything. We hope everyone's having a safe and happy new year, and we'll see you in the office, or we'll see you virtually here for tax time. Thank you, and have a good night.